Hello, everyone. My name is Alexander. I run a stake pool on the Cardano blockchain called Monad, named after my love of Haskell and functional programming, although I'm not the best functional programmer. In my day job, I am a kind of applied AI ML engineer, which I explain as I'm not smart enough to publish AI research, but I can read other people's papers and look at their notebooks and basically figure out what problems that they've solved and how what they're doing could be applied to various industry problems in whatever industry I happen to be working at that time. And then basically train models repurposing whatever it was they were doing to the specific problems that the company I'm working for has. Which is to say that I am familiar with programming and I work kind of in that kind of, what do you call it, model training and deployment. Probably as far as I go in developer operations is packaging up these trained AI models to basically run in what's called inference mode, where we're not training them, but we're just feeding them data and getting back their predictions or their classifications or whatever they are on an AWS Lambda service so that other people can integrate them into the systems that companies are using. So today I have an idea I'd like to talk about, which is for the Fund 4 of Project Catalyst. And it's I think it's a pretty cool idea. I think it's pretty fundamental to, if Cardano wants to bill itself as a worldwide global operating system for, or global financial operating system, I think insurance is actually a pretty basic and fundamental tool that provides a lot of value to people, whether or not we think about it a lot, right? Like probably one of the most unsexy things is insurance. But I'd actually like to break it down and kind of from first principles think about what is insurance, how does it solve a problem for people, and how can we use it on a blockchain and more specifically Cardano, right? So I'm going to switch over to a tablet, right? And let's see. So at its core, insurance is usually between two parties, and nowadays one of those parties tends to be a giant corporation, right? So this is my attempt at drawing a skyscraper. You can tell it was a long time ago that I was an architecture student. And what are these two people doing? Well, one of these people, this guy on the left, they've got probably some risk, right? And hopefully some cash. And the other guy on the right, he's probably got capital. And capital is a fancy word for cash, but means they have a lot of it, right? So things that would normally maybe wipe out this guy on the left are not so significant to the guy on the right. The thing there that's a little bit tricky or fun is that people with capital tend to seek something else, which are yields, like ways to make their money work for them, right? And so usually what happens is this person will give their risk to the corporation along with their cash, and they won't get the capital in return, but they'll get something that the capital provides, which is we can call this like peace of mind. I'll abbreviate to POM, peace of mind, right? Or the ability to recover from a disaster. So something that would normally wipe them out will only cause them, inconvenience rather than financial disaster. So how does this usually look, right? So if we think of an example, we can say that, our person over here has a house. And maybe this house is on a nice little hill. And if he's lucky, it even has a tree over here. Right? And so let's say one day this tree falls over onto the house. Actually happened to a friend of mine I grew up with recently. Really sucks. And what's going to happen here? Is the insurance company just going to give him money because a tree fell on his house? No. Unfortunately not. So what's going to happen, right, is we're going to kick off this process whereby the insurance company is going to send someone over to the house, right? And what are they going to do? They're going to do probably three things in roughly this order, right? One, they'll verify damage occurred, right? Is the house actually damaged or not? If not, they can go home because then nothing really happened, right? Two, they'll try to ascertain probably the cause of damage next. And this is important because insurance, even if it's called comprehensive insurance, is almost never comprehensive, right? So you can imagine that, let's say there was a little creek over at the bottom of this hill by this guy's house, and let's say it was raining for a long time, and then this river kind of overflowed its banks, eroded the shore, and loosened the soil underneath the tree, and then that's what caused the tree to fall over. It could be, I'm not sure if this is exactly would be covered or not, but you could imagine a scenario where the insurance company would say something like, well, water-related events are not covered by your policy, so we're not going to pay out, right? If it was covered, though, they would then, after they verify damage occurred and the cause of the damage, they would go to, what is the depth of the damage, or the estimate, right, of the cost. Right, and this is a pretty expensive, time-consuming, and not great process. And I've read estimates that anywhere from 25 to 35% of an insurance company's costs are in this kind of claim verification process. That's what this is called. And this presents a problem for us, not because it's costly, although it is, but because, blockchain stuff, we're not interested in sending people out to go manually verify things. So I got to thinking about this, and I started to think, is there a way that we could do this so that we can rethink what insurance is and what it provides, and kind of make it more compatible with a blockchain way of doing something. And so the idea that occurred to me is that usually, or as described in this thing that we just went through, you're insuring a house, and the house probably has some fair market value. Let's say this is a $300,000 house, right? But the insurance is centered on the asset. And what I think that causes all these other problems, which are based around the claim verification, right? Because it's focused on this object in the world, you have to do a lot of stuff in the real world to verify that something happened to it. And what I would like to do is to basically create a marketplace and allow people to price insurance policies which are not based around assets, but are based around events. And so rather than, let's say, you could buy a policy where, if rainfall occurred greater than some amount at some location, you'd get paid out. And if we think about this, there's actually an initial place that I'd like to kind of imagine this policy working. Please excuse my crude drawing of the United States. Let's say, now this house is over here in Southern California, and let's say that an earthquake happened somewhere up here, right? Earthquakes have a nice property from our perspective that they have a kind of clearly defined epicenter usually, and a magnitude, right? And there are many sensor networks all over the world that detect earthquake or seismic movements, right? And those are both governmental agencies as well as academic institutions. And, the other great thing about them from our perspective is that for large earthquakes especially, more than one entity is likely to be able to detect that earthquake. I think, with the larger ones, you can get, not just adjacent countries, but adjacent continents potentially can detect these the waves that travel out. And so we have many reliable, verifiable sources of truth from which we can build an oracle pool. And just from a data structure perspective, right, it's kind of a simpler problem to kind of understand that you have a point and a radii. Well, radii being the magnitude, and the point being the center of the circle, being the epicenter, right? And you can imagine, a contract that basically checks whether or not the location marked in the contract was within the let's call it the reach of the earthquake, right? So what might a contract like this look like? Let's draw it up over here. How do we want to do this? This is going to be, actually, let's do it down below. I think it'll be easier later. This is going to be our smart contract, right? And we can say that, if something happens, and this something is going to be a type, it's going to be a disaster, right? Or an event more broadly. But if something happens greater than a magnitude, in our case of the earthquake, less than a distance from a latitude, longitude, or location, beginning a start date, right? Start date, or a timestamp, really, right? That is a start date, until another end date. Payout, some amount. So let's fill this out for us. So if earthquake, as we discussed, greater than maybe magnitude 7, 7's a pretty big earthquake. Less than, let's say, 200 kilometers. Ooh, that's not able to be read. 200 kilometers. Let's put a unit in over here. 200 kilometers from here. I'll just put a XY to represent a latitude, longitude. Beginning, let's say, April 1st. So 2021 0401 until 2022 0331. I don't know if March has 31 days. Payout $300,000. Right? This is roughly what a smart contract would kind of cover, right? Of course, there's an address for the person and for the insurance company as well, but just to represent them, let's draw them in over here. So there's a person who is kind of floating this contract out there, and then rather than there just being a what do we say, a corporation, there could be one person, or there could be actually a group of people. We don't really care, right? Who could potentially bid on this contract and provide, risk, take on the risk of the person who was seeking to get rid of it. So you could imagine a few scenarios where maybe there's a wealthy individual who's like, hold my beer. And he's bidding the whole amount for 300,000. Right? Loaded dude. There could also be, as we were saying, a group of people who maybe don't even know each other, potentially. But they're bidding, saying, we got this. and maybe one of them has 100K, another has 100K, and then two guys, have 50K each or something like that. It doesn't really matter, but in sum, they add up to what the person is seeking for. Well, this sounds like we have something working, but actually we don't really if we start to think about it, because in a traditional kind of blockchain contract, we want to prepay for things, because let's say the premium ends up being around $1,000, right? That this guy is supposed to pay in roughly, let's say that's what the kind of market has converged at for the $300,000 policy for 1 year, only for earthquakes, right? The issue with that is if I have $300,000, or if a group of us has $300,000, getting $1,000 for 1 year is not really an attractive kind of yield, right? And so normally how we would, take these funds and we'd put them into escrow in the smart contract in case it triggered. That's not going to really work, because we're not going to have enough people who are interested in underwriting these contracts. And so the idea that I kind of came up with is that there's actually a kind of meta contract over here, which is basically responsible for kind of registering insurance companies. So we'll call this a charter, right? And you can imagine the charter would basically have something along the lines of, an address which held the funds of the company and could be, sent money to, but not withdrawn out of unless the contract was killed or ended, right? And it can only be ended when it has no liabilities or no outstanding insurance policies, right? So it's a deposit only thing until it has fulfilled all of its obligations. And second, it has a max leverage ratio. This is really illegible with this marker, sorry. And that leverage ratio might be something like, let's say, 20x, which means if someone starts an insurance company and they put in $1 million ADA into this fund, then they can go out and bid on like 20 million ADA of insurance, right? But that actually also doesn't really work, you'd say, because what if this person sells $20 million of earthquake insurance in Tokyo, an earthquake hits, and then they have to pay out 20 million. Sorry, I'm using dollars and ADA interchangeably. 20 million ADA in one go. Well, actually, because we have this kind of like a type system type stuff over here, we can kind of build into this marketplace this idea that contracts cannot be doubled up more than a ratio of 1-to-1 leverage for a certain type of disaster within a certain radius of some locality. So just to use an example, you could, if this person had $1 million ADA in the contract, they could sell insurance up to $1 million ADA in Tokyo for earthquakes, but they couldn't sell it probably in Yokohama, which is the city next door, or maybe even like Seoul in Korea, because those countries are just too close together. And if an earthquake were to strike in the middle of between the two, maybe it would mess up both of the countries. But they could sell insurance probably in Mexico City for earthquakes, as well as London and maybe Morocco, right? And they could sell 20 million ADA worth of that if they were using this contract. So just to be clear, this contract is actually what someone would bring to the table and sign up for a deal like this. And that helps a little bit, because, or quite a bit, because now we have a mechanism whereby these people can get a decent yield, right? $1,000 every time they sell a policy, as long as they're selling policies that are they're charging the right amount for the likelihood of the event happening. They should be able to come out ahead, and there should be people who are willing to supply insurance on this platform. But there's still a problem for our individual over here is, if they've paid in 1,000 ADA and it's good that the insurance company pays out when something happens. They're still kind of shit out of luck if they're not the one that got paid out. And so there's an actually kind of important idea here, which is that this $1,000 premium or whatever the premium is only kind of deducted into the smart contract per unit time that is actually transpiring. So to be blunt, if 6 months into the contract for a 1-year contract, this guy has bad luck and he has to pay out his entire balance of his insurance company's capital reserves, or his insurance contract's capital reserves, to someone else, and this contract no longer exists on the network, then this person can get their 500 ADA back. And why 500? Why not 1,000? Well, technically, they have received 500 ADA's worth of insurance, because until that point in time, if something had happened, if an earthquake had happened at the location that they had specified, they would have been paid out, right? And so they have received insurance even though they haven't received the payout. So we can say that that should be 500, and maybe this other 500 should go to him, or should continually be dripping into that charter, right? Be transferring on some kind of time basis. Well, we can kind of do what we did over here on the right and imagine kind of meta contract for our insurance seeker, which is actually very similar to this document, and is basically like a meta insurance seeking contract, which describes the kind of conditions that they're looking for, and maybe the kind of terms that they're willing to accept, certain price levels and certain leverage ratios, right? And in the case that a insurance provider of this contract goes bankrupt, it might automatically go out and seek a replacement, right, that meets the kind of standing conditions of the contract. So in that way, the person can be kind of protected by or from both the event they're trying to insure against and the counterparty risk, it's called, of one of these guys disappearing, right? And it actually kind of makes a case for why this kind of multiple insurance provider scheme might be more advantageous than a single provider, right? Just from a risk defrayment perspective, if any one of these people goes bankrupt, it's much easier to slot in another, $20,000 of coverage than another $300,000 of coverage. So that's something to think about there. And just in case it wasn't clear earlier, the whole idea kind of similar to how Tesla started with the Roadster and then went to the S and then the E and then all these other cars, right? The Roadster was a low volume, high price car that allowed them to get to market and start making revenue. So for my thinking, earthquakes are kind of a good entry point because of the reasons we described above, but I actually see this having applications above and beyond that, right? So you could do the same thing for hurricanes, right? If we draw the path of a hurricane and draw the radii, and then calculate, if you're under the thing, or if alternatively, if you have a bunch of citizen scientists, weather meteorology stations, you can detect actual wind speeds in an area, and you have enough people that it's not feasible to fake the data of so many different feeds. You could do the same contract for wind speed based projections. And one thing that I'd like to kind of focus on here is that because we are triggering by events rather than by losses of damage, that allows you to sell a single insurance product to multiple people for different reasons. So imagine you're like a wedding planner in Florida, and every hurricane season it can screw up your weddings if you guys have a bad hurricane season, and maybe for whatever reason people are dumb. Peak wedding season is peak hurricane season, right? And so if you have a bad hurricane season, you lose like half of your revenue for the year in those 1 or 2 months of business. So you might buy a policy that is for hurricanes, and rather than using it to insure against the risk of your home being damaged, you would only buy it for 2 months, and you would do it for your wedding season duration or peak business time, and you'd be protected from the loss of revenue potentially that could happen because of kind of extreme weather event, right? And lastly, actually, even before earthquakes, probably the first kind of deployment scenario is actually on-chain metrics. So naively, we could say like things like a volume, just raw volume, or transaction number, right? But these metrics are a little bit easy to spoof, right? We can keep sending money back between two addresses, back and forth, and just create a bunch of volume. So something like the if you've ever heard of this idea of days destroyed, the idea is that, if you're not familiar with it, is if I have 100 ADA over here, and I send, let's say I got it yesterday. So if this is today, this is, I received it one day before. If I send it to B, this transaction has 100 days destroyed because it's 100 ADA and it was received one day ago. So it was last touched one day ago. So I've destroyed effectively 100 days of like rest on the network. And if B sends it back to A the moment they get it, it has, a fraction of a day destroyed because it was received only moments prior, right? So this one idea is that even before earthquakes, we write up these kind of contracts based around certain on-chain properties that we can monitor directly through the Cardano node and potentially through the, how do you say, smart contract. And I think that's about it. If you have any questions, this was a pretty rough, random video. I'd be happy to answer them down below in the comments, or you can reach out to me on Telegram and a bunch of other social media places that I link to in my YouTube description down below. I'd like to thank you for spending 30 minutes or so talking to me, listening to me. And if anything wasn't clear or you have any other ideas for this, I've already gotten some pretty interesting feedback from people who are in the insurance industry and some other people in finance. I'm kind of thinking that I'm hoping that this Catalyst proposal funding is just beginning. I'm talking to another friend of mine from my undergrad days, and potentially thinking about if we can validate this idea with the Catalyst funding, or that people are interested and think it is valid. Maybe we can get some additional funding through other networks, right? And so this is could be the beginning of something quite fun, and I think it's a pretty interesting story. A few other quick properties of this is that because it doesn't have this claim verification process, it's also possible to use something like this for rainfall insurance for agricultural farmers in rural areas that don't have access to lots of capital, because you can use giant weather satellites or a network of weather satellites to measure rainfall all over the world, and then you could offer insurance against drought, which can really mess up a rural farmer's day or year, right? That would be one application. And I think that kind of fits really nicely into the whole Cardano banking the unbanked idea, and allowing there to be this kind of base level thing that you and I probably take for granted. That we take it so much for granted, it bores us, right? And like, blah, the last thing you want to do is have to think about insurance. But imagine you live as a person where insurance isn't available, where every day you're going out, and if something unpleasant happens to you, you don't just have the pain of that day. You have potentially financial ruin, and even death and starvation come upon your family because of some bad luck. And that's basically what insurance is, I think, at its core, meant to kind of address. So that's getting a bit rambly. I'll cut it off, and I hope to hear from you, and I'd love to think things through and develop this idea together if possible. Thank you. Looking forward to feedback. Bye bye.